Susanta, thanks for joining us for this INBrief video. If I think about advisors, Susanta, and they're trying to look for opportunities, why would they look towards listed infrastructure in Asia, particularly when, as a region, it's better known for its tech and its financials?
You are absolutely right. Asia is often viewed through tech and financial lens, but many times it overlooks a large and underappreciated part of the market, which is infrastructure. Infrastructure is an established asset class that is defensive and countercyclical. Every economy needs power, water, transport, data, logistics, literally on a daily basis, regardless of the macro environment. And periods of uncertainty, inflation concern, and particularly now, as we speak, when market is narrowly focused on AI-related themes, and there are geopolitics pretty much everywhere. I think the global asset allocators typically put a certain allocation into infrastructure as a diversification, as we are seeing today. Asia Pac has an additional advantage on infrastructure because the demand is supported by population growth, demography, relatively young demography, urbanization, and as well as technology adoption. Our Tribeca Fund provides a liquid way to access these essential assets using a long-term buy and hold approach, focusing on secular themes rather than short-term cycles.
And you just referenced, Susanta, that the AI boom that all advisors and their clients are aware of. How are you thinking about the intersection of the higher energy demands, the rollout, and what that means in terms of the energy transition and digital infrastructure?
You're absolutely right. Again, here there is a deep connection between AI infrastructure and power needs. As you all know that increasingly the power data centers are extremely power intensive, and hence the need for reliable electricity generation as well as the power infrastructure. What is most interesting, people do not realize that the biggest bottleneck for data center, particularly in the Northern America, is not necessarily the lack of power, but the connectivity. And that's why the power infrastructure is even more important than just the power generation. At the same time, if you look at energy transition, it is probably the biggest opportunity in multi-decades because we are moving from carbon fuel to kind of like a zero carbon over a period of next 10, 20 years. But we should do it in a pragmatic fashion. And for that, again, we need lower carbon exposure, but we need the connectivity. That is the energy infrastructure. So therefore, we are essentially looking at a kind of a convergence of having power infrastructure helping both the DC boom and as well as the energy transition. And hence, energy transition and data center investment both are very critical part of the portfolio and probably the largest themes on our portfolio. On top of that, Asian data center is even more interesting because they are coming from a much lower base than what the US is. And the valuations are far more attractive. And most important, Asia doesn't have power shortages like the US. So therefore, we are looking at the energy infrastructure and as well as the data infrastructure which support the AI rather than just directly being in the AI race itself.
Susanta, I'm interested about the portfolio, Asian listed infrastructure. Could you capture some of the businesses and the assets that are held within it? What does it look like in terms of sector, in terms of geography, and how's it evolved in terms of allocating to countries like Australia and China?
We run a kind of like a concentrated portfolio because this is a long-term buy and hold kind of thesis. So we own 25 to 30 names in the portfolio. Within no specific country, probably the upper limit is somewhere around 20-25%. The countries which we have exposure like Australia, China, India, New Zealand, and ASEAN. Sector-wise, we actually focus on five core themes which are quite secular. Energy transition, which we already discussed. Digital infrastructure, again, we talked about it. The other three are aging demography, consumer-facing infrastructure asset class like toll roads, airport, etc., and the supply chain logistics. Allocations are purely made on bottom-up driven valuation approach fundamentals But overriding criteria always is the quality. The quality of the asset, which you mean the stronger moat, clear regulations, and as well as durable cash flows. Australia and China both are very important roles, but they are part of diversified opportunity-driven framework rather than just a top-down country.
So, Susanta, what are the diversification benefits of this Asian listed infrastructure portfolio, and where do you see it sitting more broadly in a global allocation?
I think the listed infrastructure within Asia plays a dual role in the portfolio. First, it acts as a diversifier because infrastructure businesses, as we discussed, act as a defensive and counter-cyclical, and the returns are related to the driven by essential services rather than discretionary demand. This is particularly true when the equity market is dominated by narrow themes like AI. We haven't forgotten Liberation Day in April last year when the entire market went through kind of a bungee jumping. Infrastructure asset class held much better because for the same reason they are essential services. Secondly, it's a growth allocation in its own right because the growth are a secular growth. It is not a cyclical growth or a month-to-month driven story because pretty much there is a urbanization, traveling, digitalization infrastructure, energy transition. They are all long-term trend. But what is very important for the listed infrastructure versus private, that listed asset class provide transparency, liquidity, which I think is very important in today's world. And in many cases, the valuations are more attractive. Quality assets are available both in listed and as well as private space. We have seen like Air Trunk deal in Australia last year took place at a 30% premium to the public market. And that shows the need and the liquidity and the attractive valuation of the private public market. We see it's a liquid driven real asset solution into the infrastructure in Asia space. That's what Tribeca Asia Infrastructure is all about.
Susanta, as we wrap up, thinking about the fund that you lead, it's performed exceedingly well, extremely well over the last few years, and yet it avoids some of the traditional sectors that have done so well, such as consumer and tech. What do you see as being the secrets behind this success?
I think for any active fund, two things are very important. One is picking up the right stocks, right themes with a strong motor on that. And second is holding them over a long period of time. And these are the two key sources of alpha generation. What we need to important is that our return drivers are very different than the broader index. We do not own semi stocks, we do not own banks, we do not own the FMCG names. And hence, the getting the alpha actually creates a lot of value for the fund managers because they are coming from a very different set of stocks, very different set of return drivers. And again, if we have seen is that most of the underlying assets which we are getting are very secular, even within tech and consumer. For example, in consumer, we have investment in things like airport, toll roads, student acco, medical tourism. These are essentially secular driver, and their needs will keep on compounding and Asia gets more prosperous. At the same time, in AI technology, we do not take the technology risk, but we buy the infrastructure which has a long-term take or pay agreement or the pricing. Hence, the reflection, the point what we are trying to make it is that this is asset class not only has the diversification and different drivers, they also have their secular growth elements. So in summary, we try to have a disciplined buy and hold style, owning the businesses which are predictable cash flows, and hence the 1/3 of the return comes from dividend yield, which is very important part of the business and fund, and 2/3 comes from capital appreciation.
Very nicely explained. I think it's a wonderful portfolio. I think local advisors in Australia are going to be looking at it increasingly closely. Thank you for your time, Susanta.
Thank you. Take care.